Let's go to Mary Holm now, personal finance expert. Hi, Mary.
Hi, Jess.
I have been meaning to ask you what you made of this policy this week, this idea of using your KiwiSaver fund as your bond if you're a young renter. It was in the news.
Yes, so the National Party's come up with this idea. And look, I don't think it's too bad, but on balance, I don't love it.
Okay.
You know, I don't like people messing with KiwiSaver. I think we're meant to be saving up money to spend in retirement, and the more sort of bells and whistles that get added, the more complicated it gets. On the other hand, with a bond, in most cases the person gets the money back. So the idea is that if you've got money in KiwiSaver and you need a bond money, I don't know, $1,000 or something, to put in with tenancy services, the MB fund, then you can take it out of KiwiSaver and then put it back in again at age 30. So it's not too bad, but you are missing out on returns on that money in the meantime.
Yeah.
And it does complicate KiwiSaver. You know, I think a lot of people don't really fully understand and appreciate KiwiSaver, and so a lot of them are in it, but they've stopped their contributions or just not taking part, or they never have been in it.
Yeah.
And the more complicated it gets, the harder it is for people to just see what this is and what it's actually for. So overall, I'm not a big fan.
Okay.
Yeah.
You're giving it a C+.
Yeah, that's right.
Okay,
yes.
Have you've talked to the detail about this?
Yes. Actually, I just been doing an interview with the Detail Show about this topic, and I think it's probably going to run sometime next week or sometime soon. Yes.
Yeah, look out for it. It's our daily podcast that we do with Newsroom. Let's go now to today's topic, and this will be one that increasing numbers of people will be thinking about, I'm sure. And that's tight times for mortgages.
Yes, yeah. And Horizon Research just came up with survey results recently. They say that a third of adults have a mortgage. So the other third are either don't own a home or own a mortgage-free home,
I saw it was stats. Stats was a third.
Was it? Yes. Yeah, which is interesting. It's more for the 35 to 54-year-olds, which is kind of what you'd expect. They're the ones with the mortgages. And almost half of those have got their interest rates being reviewed between June and December of this year. So they're on fixed rate mortgages, and the terms are maturing, and so they're worrying, a lot of them, because the interest rate will inevitably go up, given the way interest rates have gone in the market lately. And 3%, so it's quite small, but 3% of people with mortgages, now this is a quote, they thought they might definitely have to sell in the next 12 months. I'm not quite sure what might definitely mean.
Terrible grammar.
Yes, but it's not just terrible grammar, it's a bit hard to work out exactly what, because they, definitely, and then might definitely, but it was higher for the younger people, for the under 35s. One thing to note in these numbers, I went back to Horizon Research and I said, does this include people with mortgages for rental properties? And they said yes, and they didn't break it down between the two. So there might be some people who've got their own home without a mortgage, but they've got a rental property with a mortgage. That's probably not uncommon. And so that's not as big a worry in a way if they're worrying about their mortgages and feeling they might have to sell their property. If it's a rental property, that's not a big deal. But if it's their home, it is a big deal. 70% are worried about affording new higher rates. But that's kind of, I think, well, everyone's going to say that at the moment, really. I'm surprised in a way it's only 70% because everyone's interest rate has going up a lot, but so we've got a small number here, with 3% that are feeling like it's quite likely, let's say, that they will have to sell, and that if they just have to, I shouldn't say just, but if they have to sell their home and move to a cheaper one, that's not that big a disaster. It's not a happy situation to be in. But when they looked at how many have actually missed payments on their properties, it's only 1.3%. Now, that's still not good, and it's quite a long way up from what it was.
Is it?
A year or two ago, I understand, yes. But you know, years and years ago when I worked in Michigan, and I don't know whether I told you this, but there was a group of women there that started the Michigan Women's Bank. It was called. I googled it recently, and it's not there anymore. But it was started because banks weren't really serving women very well. It was part of the early feminist movement, and they were lending mortgage money to people that couldn't get mortgage money from anyone else. They were often single mothers, and in Detroit and places like that. And hardly any of them ever foreclosed on their properties. They said they would do anything to keep their houses, these people. They so valued owning their own house. And I think that'll be the way it is in New Zealand too. I don't foresee a whole lot of foreclosures or anything. I think people... That's one thing telling someone doing a survey, yes, I'm really worried. It's another thing actually losing your house. Yeah. And as I say, if you're moving to a smaller house that's cheaper or to a cheaper area, that's one thing. But actually getting into big financial trouble over all of this, I doubt if that's going to happen in a big way. But anyway, for those who are still, they're not in deep trouble, but they're still worrying about it all, there are a few points to make. And the first and the most important one of all is to talk to your lender, preferably before you start missing out on payments. And I reckon you would find always that they're polite. They're not going to start telling you off. And, they might, if you say, I can't afford to make my mortgage payments, they're quite likely to start asking you some quite hard questions about your spending, perhaps. But that's not such a bad thing to happen anyway. I mean, they might come up with some quite good suggestions on how you can cut spending or get some help from, say, a mortgage, budget advisory service. But
they might not be on your side. But in that circumstance, they probably will at least try to be.
More so than a whole lot of other situations. I think they are, because the lenders don't want to foreclose on properties, and they don't want to be chasing around people who are making slow payments, because it gives them a terribly bad name, and it's a lot of work and a lot of expense and it's ghastly for everybody. And lenders really don't want you to keep on paying at least what you can, and things come right. So, there are three different sort of solutions that a lender might come up with to help you make ends meet. If big interest rates rate rise is leaving you worrying about meeting the new payments. One is to just change the term of the loan. So if the term is how long the loan lasts. And if it's, say, a 20 or 25-year loan and you can extend it to 30 or 35 years, that reduces the monthly payments or the fortnightly payments, whatever regular payments you're making. I just did one example of a $400,000 mortgage if it goes up to 8%, changing from 25 years to 35 years, excuse me, just have a sip of water here.
Yeah, please do. I'm talking to Mary Holm, a personal finance expert, on ways you can ease the pressure if your mortgage rate's going up.
Yes, thanks, Jessie. Help, sorry.
I've got that as well at the moment.
You? Yeah, these things are going around. Changing from 25 years to 35 years, you'll be paying about $250 less a month, and that helps people. Mind you, you'd still be paying $2,800. So we're taking $250 off, and we're still paying $2,800. So it doesn't make a huge difference, but it does help people somewhat.
And it will mean you'll pay more interest over the...
Well, that's the point I'm going to come to in a minute. Okay. Yeah, but you're quite right, it does. Another one is a more sort of radical change is to change to paying interest only. So you kind of stop the repayments of the loan, and you're just paying the interest. You're kind of treading water with that one. And on that same mortgage of $400,000 at 8%, you'll be paying $420 less a month. So a bigger reduction in your monthly payments there. If that's still not enough, I mean, if for example you lose your job or you suddenly had a big drop in income or a big increase in expenses for some reason, you might be able to pay nothing or very little for a while. The lenders, obviously, they're going to be, asking you some quite tough questions about your spending, etc., to do that. But you can have a sort of mortgage holiday, and that they're much more likely to listen if they can foresee something happening in the future, that you're going to get another job or something's coming up that will help you get through the crisis. Or you might not go down to paying nothing. You might halve your payments, say, for a while. There's all of these options are there, and they really can help people, but they all mean you're going to be paying more over the long term, which is what a point you made a while back. So changing in that mortgage example I gave $400,000 at 8%. Changing from 25 years to 35 years, you're going to pay nearly $270,000 more, so more than $250,000 in interest over that 35 years than you would have paid over 25 years. So it does make a big, big difference to the interest.
I guess you could move back to 25 years when interest rates go down in the future.
Yes, absolutely. And that's what you want to do. You want to do this for the short term, short as possible. You certainly wouldn't want to just keep it at that longer term. Excuse me, indefinitely. And if you change to interest only or paying nothing, you're going to be paying infinitely more interest over the life of the loan. So that's only. I did that once. There was a period in my life where I did something that I always advise people not to do, and that was I bought a house before I sold a house, and then it took longer than expected to sell the house. Yeah. And so the bank let us pay interest only on the mortgage on the new house until we'd sold the old one. And because the bank could see the end in sight, Yeah. So those are the sort of situations where you can say, hey, bank, or whoever the lender is, here's why I need a break for a little while, and that'll tend to work.
All worth at least doing the numbers on.
Yes.
And as you say, if the alternative is losing your house or being forced to sell your house, then these will be looking like pretty good options.
Yes, and I'm sure people are looking at ways to cut their spending. I mean, I could just quickly add here that if you're not that sure how you can cut your spending, go and talk to a financial mentor. They're free through the Money Talks website. So it's Money Talks, one word, and they have mentors all over the country. They're not just in the big towns, and that's free to you, and they'll look with you through your finances and help you. All sorts of things like if you're paying rates, then you might find if your income's low that you can get a break on those rates. There are councils that will reduce your rates if you're a low income person, or you can get a rate postponement where you still have to pay the rates, but when you finally sell the house, and in the meantime you don't have to pay them, and that can make quite a big difference to someone, and that money will be left over to help pay the mortgage. So if you're
just
struggling,
some fresh thinking.
Some ways to
Before you go, Mary, you also were interviewed for RNZ's program Media Watch.
Yes.
Well done. What was the topic of conversation?
That was about having possibly the longest running column in New Zealand in mainstream media. They came up with some examples of people in some small publications or specialist publications, but it all started because in the same ways that the Herald they were saying that she had possibly the longest running column at 21 years And I just sent them a cheeky email saying, hey, mine's been going for longer than that. I didn't expect much more from them. I just thought they'd laugh, and I was laughing about it. But they said, oh, okay, come on and talk about your 25 years.
Right.
So that was fun.
Yeah.
Yes.
How long's your one been going for?
25.
Oh, 25 as well.
Yeah.
Okay.
But Jesse, you and I, we go back to 2015 now. So we've got a 10-year one coming up in a couple of years.
Yeah, great.
Yes.
I'll be there, I
Yes.
hope.
yes, me too.
And you definitely will be. Thank you, Mary.
Thanks, Jesse.
Mary Holm with some ideas on mortgages today.